Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Market Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. There were until recently two key patterns here, but now there are three. The first and larger one is the February 2021 to July 2022 ascending broadening wedge pattern. Currently 743.5 to well up off the top of my daily chart, far enough that it makes it immaterial. This was not a perfect pattern, but it had been the main market driver higher in the early part of this year. The break lower in July left the following incredible targets on the downside. The primary target X is in the 352 even area, with a harder to reach secondary target X1 in the 217 area. These are obviously, well, pretty much way out there targets that you can put into the back of your diary on the back page and just look at them maybe once a year. The second smaller pattern was in development until the end of September, and on the surface seems a more reasonable opportunity. It was created from the break lower of the larger pattern in June and July and is an optimized falling wedge pattern, currently 572 3/4 to 550 3/4. The key features have been the temporary halt to the decline at the February low of 599 3/4 back in August, the earlier breakdown through the 50% Fibonacci line of the December 2020 to April 2022 move at 644 even, the false break lower in mid-September below the lower trend line, and above all of these, the break higher up and out of this falling wedge pattern at the start of October. This break higher continues, though it ran into a lot of headwinds in its attempts higher during the earlier part of October. Now, before I start recapping my previous highlighted possibly upside targets for this pattern, I'd like to reiterate something I've said these past 5 weeks now. There is a key problem with this pattern. It has been created in the wrong place. By that I mean it should have been formed after we'd had a prior ascending pattern, not as in this case after a great big gapping drop lower. This had previously led me to suspect that perhaps this pattern may morph further along into something else. Until recently I had not noted anything special, but last week I was minded of the action as a third pattern, a late June to date very big V-bottom type pattern. An extended V-bottom with a flat hesitation area had formed during October. This pattern gives potential up to the 690 even area, and it would in part tie in with potential targets for a break upwards from the falling wedge pattern. Thus, a primary target X2 for this pattern would be in the 702 3/4 area, and a secondary harder to reach target X3 would be in the 757 even area. This week the market broke up over and started to stabilize over the 50% Fibonacci line of December 20 to April 22 move at 643 3/4, which had been a stubborn stain that didn't seem to want to move, as well as coming in from above the declining medium moving average, currently 644 even. This had been in effect a new resistance that hadn't been tested since June, so I was cautious last week when mentioning it, especially given how we'd already pierced it today. Looking higher, we've had a little in the way until the mid-August high at 671 even, which peaked yesterday and created a combined bearish pattern which has seen some, though limited, move lower. However, beyond that, we really only have the ever so slowly dipping long moving average above, currently at 704, which interestingly is very close to the target X3 at 702 3/4. Winnipeg canola. Whilst the September 2021 low at 839.20 and the August 2021 low at 817 even both acted to halt the declines back in late June and early July, it was originally the 50% Fibonacci line of the October 2020 to April 2022 move at 863.80 that triggered the retro reverse engines to pull prices up all the way back in late June, which is kind of ironic as it is now during most of October been acting as a support for an attempt higher. Going back to the summertime for a moment, it became evident since the start of the sideways to slightly lower movement we've seen here since June that there was a shallow bear channel, currently 775.60 to 877.10, and it's this has been driving the recent market lower. To emphasize this point, I'd like to recap some of last week's commentary, and I quote, "So it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market. This leads us to what's happened since mid-September today, where we had a nice rally from the bottom of the bear channel, reaching the upper bear channel line at the start of October. Since then we have been confined between the upper bear channel line and the 50% Fibonacci line at 863.80. This situation cannot last, even though ranges could narrow into the start of December. I suspect an event will take place that will trigger a move before then." End of quote. Well, it looks like that event may be happening this week with two clear closes as of last night over the upper bear channel line and the whole of October between roughly 863.80 to 880. Now, acting as a support, that's what it's doing. This leads again to something I highlighted last week, and I quote, "So what is there left that could influence the market? Well, I had previously discussed the ideas that perhaps, just perhaps, the mid-September to date action is in the form of a rather flat bullish halfway hesitation. I'm not altogether happy with this, but it may just fit. If it does, and is way early so far, then we could be looking at a move up to the 960 area. Mind you, at this time, it could quite as easily be a topping action, and we see the lower bear channel revisited once again." End of quote. It looks like this week the market is taking seriously the idea of a flat bullish halfway hesitation. So what do we have overhead that may impede the move higher? Well, the obvious ones are the highs of October at 898.5, July at 904.30, and late June at 912.70. I'd also add to that the 50% Fibonacci line at 921.70 of the January 2021 to April 22 move, though this one did not show any support on the way down back in June. We then have congestion at 945.10 and 959.80 before we get to the 960 number. I would also add that just above that, we have the slowly declining long moving average, currently 972.20, which is slowly entering the frame. Bursa Malaysia crude palm oil. Superficially, you might think the break higher over the short medium moving average, currently at 38.61, was a key moment and move higher in recent days, and you would be partially right, but not wholly. You see, over September and mid-October, the market had formed a small but effective reverse head and shoulders pattern, and it was the combination of the break higher over the neckline of this reverse head and shoulders pattern, as well as the old neckline of the September 2015 to November 2017 head and shoulders top, currently at 38.57, and finally the break above the short medium moving average that together caused the move up since mid-October. This move higher gave potential targets on the upside of a primary target X in the 42.45 area, and a secondary harder to reach target X1 in the 44.40 area. This week prices reached target X and came close to target X1 yesterday, but finished with a shooting star pattern. This raised the interesting question, of whether this shooting star pattern was a type 1 bearish or type 2 bullish. Initial indications suggest a type 1 bearish, but the market has not followed through lower and is indeed moving higher, so the question is still open. If prices do try higher still, then the first obstacle will be beyond target X1 at the previous all-time high formed in March 2008 at 44.84. Then there is quite a sparse area above that, nothing very much there, until a band made up from the two 50% Fibonacci lines. They are the 50% Fibonacci line of the July 2019 to March 22 move at 49.64, and the 50% Fibonacci line of the May 2020 to March 22 move at 49.92. Beyond those, we have the slowly declining long moving average, currently 52.10, which is far enough away to cap any likely immediate rise. The key question now is whether the market will continue its rise, And what will it do if the March 2008, what will it do at the March 2008 previous all-time high? Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.